Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Even with today's 37% increase in Lyft, the stock still has a market cap, of $6-7 billion worth. Uber's got multiples of that. It
huge.
Skyrocketed in such a huge divergence. So let's break down both of those numbers. We can do that with Mandeep Singh. He follows some of the technical sectors of this market.
Pretty much follows
everything in tech.
Yeah.
So he's a tech analyst for Bloomberg Intelligence. So let's start with Lyft.
Who's getting fired?
I took a Lyft home last night because why? Because it was cheaper than Uber.
By how much?
By like 20%.
Really?
Yeah, and that's typical. One or the other. I just arbitraged the two. Matt Miller does not do that. I arbitraged the two. I thought everybody did that. So anyway, what happened to Lyft with their earnings last night?
Well, last night was bizarre because, you don't often see that in press releases.
Never. Somebody better lose a job there, as Alix would say.
Totally.
But, at the end of the day, it was, I think, just a mistake that happened. It wasn't intentional in any way. And the stock move was pronounced because of, the short interest and the fact that obviously people were not very optimistic going into the print. And look, I think in the case of Lyft, not much has changed in terms of execution. They're still kind of a distant number two. And you talked about taking a Lyft, but there are certain zip codes where they are able to meet the ETAs that Uber has. But in other zip codes, they have no supply. So even if you want to take a Lyft, there is no availability.
All right, but my dude last night, like most markets I go to, he's got an Uber sticker and he's got a Lyft sticker, and he's got both apps open.
Wait, really?
And they all drive for each other.
Yeah, there is a huge amount of overlap.
Yeah. And so literally,
it's
just here's my reading. I mean, you're the expert. It's just Uber algorithm, Lyft algorithm. They're different. They're going to give you different prices and things like that, but it was 20% difference.
But
anyway.
From a driver perspective, what Lyft is doing is they are paying out more to lure drivers.
Okay.
So if it was a $10 ride, the driver is getting $7 or $8 from Lyft, whereas from Uber they're getting $6. It's just an example.
Yes.
So that's where the take rate matters. What these companies keep versus what the driver is getting, and that's the I think tactic Lyft is using to really pay more to the driver to bring on more supply.
So then how does that then play out? So at some point they get enough supply that then they can sort of make more money per ride and increase the shares. When does that moment happen?
I mean, scale is the only moat you can have in this business, scale and operating efficiency. And so what Uber has done is, obviously they have the scale. Yep. They are 6 times bigger than Lyft in just the mobility segment. And think of the gross margin. The reason why this is a 60% gross margin business is because insurance costs is pretty high for ride sharing. So how do you bring down insurance costs? Through scale. And that's what Uber has because it does, 6 times more rides than Lyft. And in the case of Lyft, if they don't maintain the supply, then they're just going to keep losing share, which is what was happening. So they have to compete on price. The only way they can maintain their share is if they offer a lower price, as they did with Paul last night. So that's the tactic. And I don't think it's going to be...
Is that a long-term model to you?
Well, so think of what happened with food delivery. There were so many players. Now you are down to 2 or 3, remaining. It's Uber,
which,
DoorDash.
by the way, I still will not pay for my youngest in college.
I have a hard time paying for it. I'm not going to pay $10.
We've established that firmly.
I support this.
Yeah.
So there will be consolidation, but if Uber is announcing a $7 billion buyback, they're not buying Instacart now. So that's nor they are buying Lyft.
Okay, talk about that that buyback.
Yeah.
What does that tell us? Like, when you buy back stock, isn't that because you're no longer a growth company? Like, is that the thing?
Yes, I think there is that element. And also they're going to be prudent in terms of returning cash to the shareholders. So remember, they acquired the freight business. That is a big drag on profitability. Uber didn't build freight business organically. They bought a company. That didn't work out well. They bought Postmates for food delivery. That didn't work out well. So their track record with acquisitions isn't great. And so now they are saying is we are going to generate about $7 to $8 billion in free cash flow. Well, guess what? We are using $7 billion out of that for buying back our stock. I mean, obviously it's going to be over a period of time, not in the next 12 months. But I think that's good, sound capital allocation strategy. And look, this company is generating, the mobility side is very healthy. They've got, mid 20% EBITDA margins. Compare that to Lyft, which what got people excited is they could get to 20% EBITDA margins. Well, not so fast. I guess that was a typo.
So, I say, yeah. All right, how about the Uber Eats business? Again, I don't support this. I mean, I know it's a great, people love it, but not on my credit card. So talk to us about the Eats business.
This is just to drive frequency.
Okay.
Just so that Paul has more transactions with Uber.
This is just advertising then, basically.
Exactly. And the only profit they're going to generate right now is through advertising. So the good thing working out for Uber is they have a memberships business. So that's your recurring subscription. You're going to buy an Uber membership that works for both mobility and delivery. And also they're going to show ads. So ads is $1 billion run rate business now, primarily driven by delivery, and it's almost 90% gross margin.
Yep.
So that's what's going to drive the delivery profitability. But on a transaction basis, this is zero.
So this is sort of like Amazon Prime Video. Like it's just basically sell more subscriptions of Amazon Prime, up the price a little bit, and then you get more viewers who are just into it, and then they buy more stuff on Amazon. It's kind of the same
bundling
idea.
is the way. So they, like Uber talked about this concept of being a super app almost 3-4 years ago. And they have been working towards it. Now they have integrated taxi. Remember when Uber came to the scene? They were supposed to, or they actually disrupted taxis.
Yep.
Now they have onboarded taxis on the platform to boost supply. And taxis is about 5% of their business. So clearly, you come a full circle where you have integrated taxis, and their thing is, we'll bring everything related to transportation on one app. And you can find any and everything you need.
This guy, Dara Khosrowshahi, I mean, he's done an amazing job turning that company around.
Minus the acquisitions.
Minus the acquisitions.
If
They're
it
just
wasn't,
bad at buying stuff.
and that's what he did at Expedia. Expedia was built around acquisitions. There, I think acquisitions worked out probably better than they did in Uber. But clearly acquisitions wasn't.
And so one of the potential acquisitions that was out there was Instacart to ramp up their Uber Eats. But you're now saying the stock buyback signals that unlikely to do that.
That's completely out of question. I mean, the question is, can DoorDash buy something given, like, the reason why Lyft's stock moved this much is because the valuation is like 1 times EV to sales.
Yep.
Compare that to DoorDash 5 times EV to sales or Airbnb 10 times EV to sales. So clearly, a lot of the growth prospects are reflected in the Lyft's valuation.
Yeah, Airbnb, we'll do that next time. I don't know, I'm just not comfortable with that concept. But I know a ton of people are around the world and they love it, so we'll get to that next time.
Staying or renting out your house, or staying in someone else's house?
Both.
Okay.
I don't know, but I don't know.
It's really not that weird.
Yeah, going into somebody else's house.
No, because it's more like an investment property a lot of the time.
All right, Mandeep Singh, Senior Tech Analyst for Bloomberg
laughing
Intelligence. We appreciate you stopping by.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I want to dig a little deeper into the small cap world because the Russell 2000 is up 1.6%. Now the narrative, if you just rewind to Monday, was that we were broadening out this rally in the S&P, that it wasn't just big tech. We were finally seeing small caps get a little bit of a bid. Well, let's talk to Brian Smoluch. He's principal and portfolio manager of the Hood River Small Cap Growth Fund. He joins us from Palm Beach, Florida, much to Paul's pain as he looks at the palm trees in the background. Hey, Brian.
Killing me.
Do you buy small caps here? Like, are they actually going to finally make a good comeback?
I think so. The CPI print yesterday clearly didn't help things near term, given the Fed was a little bit too aggressive in December when they talked about aggressive cuts this year. But I think once the CPI does settle down to a level that people are comfortable with where the Fed's going to cut, it's a matter of when, not if, then small caps will outperform. You see that when people want to put on risk. Small cap, particularly small cap growth, tends to put on a really big move. And then in Q4 last year, when that happened, the space really ripped. And it's been a fairly protracted period of big underperformance for the last several years. So the setup is good given valuations, earnings revisions are trending positive. Spreads, which are a great leading indicator for small cap stocks, have tightened significantly to just a little over 100 basis points. So the odds are highly in the space's favor for it to outperform over the next 12 months.
Hey, Brian, am I going to get a valuation break if I go down into smaller mid-cap territory relative to the S&P 500?
Yeah, so if you look at small cap growth versus the S&P, it usually trades at a premium. Right now, it's trading around 18 times 2025 earnings versus the S&P at 20 times. So you do get a discount there. That's part of what I was saying why the setup is good, because you get a relative valuation break. Usually the growth is faster in small cap names. I wouldn't expect this upcoming cycle to be any different. So that's why you'll get probably some multiple expansion and positive earnings revisions, which should lead to outperformance over the next 12 months.
Hey, Brian, would you have made a different argument 6 months ago? Because small caps did have a moment last year, and that moment was short-lived. Is the argument different now?
I would say it's honestly pretty similar. We're bottoms-up stock pickers trying to find companies with a dislocation in fundamentals versus valuation. It's been a constructive setup, and 6 months ago, it actually was good when you look into Q4, and small cap ended up putting a move on to being up around 19% for the year last year. So it was solid, but it has been a waiting game for small cap, and you need rates to cooperate with spreads for the sector to work.
Fortress Aviation, FTAI is the ticker. What's the call there, Brian?
We like the stock. It's one of our bigger positions. It's been really huge over the last 18 months. We think there's still some significant legs left in the story for it to really work. It trades at around 20 times earnings. They have a new module repair business for engines that's growing around 100%. And we think there's upside in that area, particularly when you look at all the news in the supply chain, and airlines across the world really need to optimize how well their current engines work, given that they can't get new engines or new planes when Boeing's having all these problems. Meanwhile, the asset value on their current current engines has been moving up because of the supply-demand imbalance created by the fact that new planes really can't make it out the door, and you have rising demand around the world continuing for passenger travel.
You also have Celsius, which is it's like a Red Bull energy drink, right? I know it's different, but it's the same kind of idea. You like this company? How come?
Yeah, we've owned it for a while. It's a secular market share gainer. We think in the category, it's gone from around 2% share to 10% share. We think they can reasonably get to 20% share. They have a partnership with Pepsi that's ramped up over the last 12 months. Pepsi's the largest distributor in the world, and fortuitously they left Budweiser, which obviously wasn't great with all the Bud Light issues that they were having. And we think the street's at about 40%. They could easily grow 50 this year, and the stock's just around 13% share. And as I said earlier, we think they can get to 20.
And have you ever had one of those energy drinks?
No.
I'm scared of them.
Yeah.
Celsius
I'm sure they're great.
Celsius is a little bit healthier. It's all natural ingredients. You still get the boost from caffeine. It's 200 milligrams of caffeine. So yeah, I definitely wouldn't take it before you go to bed. But it tastes better. It's healthier than some of the other drinks out there.
Yeah, I don't know. Hey, Brian, how do you define kind of like the market cap? Like, what's a small cap? What's a mid cap for you? And what happens when they maybe grow out of those levels?
Yeah. So the last 6 months has been abnormal for the sector in that there's been a huge bifurcation. So within the Russell 2000 growth, for example, super micro is actually in the benchmark, and it's over a 30 billion market cap. So normally I would say the range is between, call it 100 million up to 6 or 7 billion, but it has expanded over time. The sweet spot really is in that $2 to $5 billion range, and those stocks tend to be a little bit more inefficient. And we don't typically sell stock when it gets too big. It's really when we think it's efficiently priced based on the fundamentals, or we think something bad's going to happen, we'll step aside.
And it's a leading question because we're talking about you manage a small cap growth fund, but growth versus value in the Russell, is it the same kind of thing as what we see in the general market? Growth, tech, everything else, value.
Well, in small cap growth, you do have a larger percentage of software companies, semiconductor companies, biotech, and a little bit less financials, and then some of the higher growth consumers. But small cap growth and small cap value are relatively highly correlated, but in different areas, there can be big dispersions. Like in 2020, you saw growth massively outperform value, and then it completely inverted the prior year. We frankly try to be agnostic and try to find companies that are growing reasonably quickly, call it 15%, but are inefficiently priced. So we kind of thread the needle there.
There's a good article in the Bloomberg Terminal today. Florida boom cools an area where home insurance costs tripled. Hurricane Ian worsened already rising homeowners rates, and they called out like Naples, Sarasota, Cape Coral. I noticed you guys own some exposure here. HCI Group is a homeowners insurance company based in Florida. Uh-oh.
Yes.
What's that about?
Yeah, so it's been a great stock because of the dislocation in this particular geography. And what's happened is the lawyers had the upper hand, not a big surprise for an extended period here. A lot of insurers pulled out because of that, because they were having massive losses. The state legislature came in, made it so that it was more reasonable and favorable to insurers. HCI was set up well to write new premiums profitably, as well as take over existing premiums from the state entity, which is called Citizens, which allowed them to dramatically outperform expectations, and earnings growth is significant. So it's trading at 11 times earnings. We actually think there's upside to that number. And they're just set up well because of supply demand in the area. And as you know, the area is really growing. So you have a lot of people moving here. So demand is strong.
As Paul talks about all the time. Mm-hmm. You do want to move there, don't you?
No,
he doesn't.
That's a hard no.
Okay, it's a hard no, but he does get jealous of the palm trees.
Yes.
What I find interesting, though, when you talk about insurers is that, Florida is going to get hit with storm after storm, and it is a bit worse now. And I just wonder how the risk premium you got to bake into these stocks.
So weather is a big issue. Obviously, during hurricane season, HCI has been here forever, and they've done a good job pricing for that risk. So you just got to assume over an extended period of time that when you take your lumps, you're going to more than make up for it based on pricing. And as you noted from that article, pricing's up huge, and there are a lot of different reasons for that. And in condos, for example, there was that condo that went down in Miami, and that jacked up premiums all over the area. And insurance companies were able to capitalize because now condos realize they just had to become conforming with state code. So to me, hurricanes are a manageable risk here. There's actually been less direct hurricane impacts on Southeast Florida than up in the Northeast where you guys are. So, but you do have a fair amount happening in the Gulf, but there's less population in Florida and the Gulf than on the Southeast side.
All right, Brian, thank you so much for joining us. As always, Brian Smoluch, he's a principal and portfolio manager of the Hood River Small Cap Growth Fund, not in Bend, Oregon, but in Palm Beach Gardens, Florida.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
I want to know what's up with Kraft. So that stock is moving a whopping 6%. It's down 6%. Organic sales decline wasn't so great. It was a lackluster end to the year, and that's really dragging on sales. So what's up with that? Let's go to Jen Bartashus. She is Bloomberg Intelligence Senior Analyst, Retail Staples and Packaged Foods. Jen, what was just so bad about Kraft?
Well, the big surprise for Kraft was that volume was down, which was not a surprise, but it was down more than prices rose. And that really put pressure on the ability to generate sales growth. And so organic sales were negative for the first time since 2020. And although there's some momentum in the business, it's got people concerned.
So, Jen, as I understand the packaged food business from reading your research and talking to you, I guess post-pandemic volumes are down, but they've been able to make up for it by raising prices more. So is that game kind of played out now?
Yeah, it basically, a lot of these companies have run out of their pricing power. And what that means is, they were able to raise prices because their input costs were higher, whether it was ingredients or transportation or packaging. But as inflation is coming down, they're losing the ability to pass through additional price increases, which means that if you want to have top line growth or organic sales growth, you have to have positive volume growth. Because you're not getting it from just higher price anymore. And the problem Kraft Heinz has right now is that volume is still down, price is lower than it's been, and they're not seeing that bounce back in volume that typically lower pricing would encourage.
Okay, so a couple things to focus on. Let's go to the product side then, because you mentioned that a few times. So volumes are down. It doesn't seem like that's just a pricing power thing. Do they not have the right products right now?
Well, I think their portfolio is actually pretty good. It's just that the consumer is not buying as much as they were before. So if you think back to pre-pandemic, people had huge pantries and everything was stocked. They had lots of boxed goods in there. And now people are still a little bit more conservative and buying more on a need basis rather than a stockpiling basis. And so until people start to bulk up those pantries again, it's hard to entice them to buy more than what they just need for this week.
So as I look at the analyst forecast, Jen, I kind of see the 1.5% to 2.5% revenue growth in the next several years. That really is the story for most of these consumer packaged goods companies, isn't it?
It really is, especially for companies where the bulk of their portfolio are what you would call center of the store items. So that's the canned items, the boxed items, that type of outlook for top line growth is pretty much in line with where you would expect normal inflation rates to be. And so that in and of itself is probably a reasonable expectation for where these companies can go over the next few years.
Do you think that prices then will come down, or do you think that they stay sticky?
Prices will slowly come down. Retailers are looking to pass through cost savings to their customers. So there will be higher pressure on packaged food companies to lower prices as well. And as their input costs or their packaging costs come down, it's harder for them to justify holding prices at a higher level and not passing through some of those savings. So while prices may never come back down to where they were pre-pandemic, they should come down a little bit from where they were in terms of peak pricing in the last 18 months.
A little bit.
I know.
I don't know if we like a little bit.
No, we don't. And
Yeah.
that's the
problem.
That's a problem. That's a problem for a lot of people, and it's a problem for the politicians who are saying inflation's still a bad story here. So, all right. So, Jen, with these names like Kraft Heinz and General Mills and Kellogg's, I got a low single-digit revenue growth. I got dividend yields for Kraft Heinz about 4.7%. I mean, what am I owning this thing for? Am I owning it for single-digit kind of maybe stock price return plus some dividend yield, and that's my game?
That's probably the value play at the moment, right? Meaning you've got steady, kind of slow and steady growth. You've got a reasonable dividend. They do share buybacks, so there's some shareholder benefit there. And as consumers start to pick up their spending, then we may see a better outlook for these companies as well.
Who does Kraft? This is a really dumb question. Who does Kraft compete with? Like the Coke and Pepsi, I know that Pepsi was all like snacks, but they have the soft drink business. Who's like a straight up Kraft competitor?
Someone like Conagra would be or Campbell Soup. Those would be kind of those center type store companies that would compete most directly with the Kraft Heinz.
Hey, Jen, I look at the holders list here, and I forgot about this. Berkshire Hathaway, Warren Buffett, by far the biggest shareholder of this company with about 27% ownership. What has Berkshire Hathaway publicly said about this investment? How long have they owned it? What do they say about their stake here?
Well, they've been involved for a very, very long time.
Okay.
Haven't made a lot of public comments lately, but when Kraft Heinz began its transformation plan, which was now a little over 3 years ago, Berkshire Hathaway was very they were very positive on that transformation story. And to be fair, Kraft Heinz has executed on that transformation plan and generally ahead of schedule when it comes to cost savings initiatives, streamlining things, rebalancing their portfolio. So they really have been sticking to that plan and delivering ahead of schedule. It's just that it's a multi-year process.
Right, and it's a tough time, and I get it, and there's inflation, and then there's the demand. Do you think that the stock move, I'm just looking at the chart here, is it overdone?
Well, part of it is the concern about the volume. And when they gave their guidance for 2024, the company actually said that they think volume is going to shift to positive growth in the second half of the year. That seems like it might be overly optimistic and is probably part of what's contributing to that stock decline today.
So, Jen, in your coverage area, you got the staples, the packaged food companies. What's the kind of the best idea? What do you talk to clients about most often?
Well, right now, we're talking to people about, who is it that has taken the least amount of price increases over the last, say, 18 months, and where are volumes holding up? Because to be successful over 2024 and into 2025, it really is that question of how are you going to actually drive overall growth and profitability. And so the companies that have been more conservative and been more prudent in that approach are the ones who are positioned right now to maybe benefit from that.
So you have
benefit from those actions.
Like what's a representative name there?
So a good example there would be Mondelez, where they took a lot less price than and actually the spinoff from Kraft Heinz.
Oh, that's right. I forgot about that.
Yeah, but they've been a little bit more prudent in terms of their price increases, and what we've also seen is that their volume has held up better. Hershey is another one where their volumes have held up, and part of that is that people love their chocolate.
That's true. I don't care about flowers.
A couple of examples.
But I'll definitely take.
We're learning a lot about Jen. We're learning a lot about Alix and her Valentine's Day preferences. So flowers, no, but chocolate.
Well, I don't want anything. I think it's stupid.
Anything.
But
it's stupid.
If one
She's
was
trying
to
to
get me
portray
something,
herself as like this simple girl, no demands. I don't buy it for a minute.
Simple girl. What? No. Do I like Valentine's? No, it's dumb. But will I eat chocolate? Absolutely, as long as it's high-end dark chocolate. Hey, Jen, what's something you really don't like right now? Like, what's sort of a negative trend? Because I'm also trying to understand for some of these names the normalization that we've seen. Sort of backtrack the last 4 years and erase that, and that's where we have to kind of pick up and go from there.
Well, I think one of the things that is an issue for the industry is that everyone still believes that they can optimize their portfolio and that they're going to find a buyer for the products and the product lines that they don't want at a good multiple. And at the end of the day, there aren't a lot of buyers out there for categories that are slow growth or declining. And so there's maybe a little bit of a mismatch in terms of the belief that they can streamline their portfolio, get all the value that they think they deserve out of it. And yet I don't see a whole suite of buyers lining up to look at those products.
Hershey. This company went public in 1927.
Oh boy.
They did one follow-on offering. Mm-hmm. And then for about a period of about 12 months in 1993 or 4, we pitched them hard on doing another follow-on. We actually had a good analyst on the name and the company like this. We went to Hershey probably 6 or 7 times in the space of a year, pitching a follow-on offering, nothing. Didn't get paid, but got the Hershey and got a lot of Hershey chocolate. There's that. So Jen, what does a company like Hershey do? It's one of those things. I know they've gotten bigger through some acquisitions, but they're still relatively a small player relative to some of the other big names. But is their brand so good that they can kind of remain independent?
Yeah, I believe that the Hershey brand is really iconic, and if you think about some of their biggest chocolate lines, there really aren't a lot of mass targeted competitors out there. So people may prefer the higher end, Alix, but but when it comes to kind of that mass market, it's hard for an external brand to come in and get the kind of penetration that Hershey has. And in addition, Hershey has really done a good job of diversifying into the broader snacking. So they own popcorn brand, they own pretzel brand. So they've done a good job of diversifying, and that'll help them with their long-term growth as well.
Really interesting. I'm surprised that John Tucker didn't have some weird factoid about Hershey, Pennsylvania.
Well, they have the Hershey school and all that kind of stuff. And,
yeah, but I mean, like weird off the beaten track, like
I
here's where the cemetery was.
I don't
of
have any
horses
fun
or something.
facts about Hershey, but I suspect it's out in that region of the world because there are lots of farms and milk cows that give milk and stuff.
I could have told you that. All right.
All
Hey,
right.
Jen,
I didn't have it.
we really appreciate it. It's so great to catch up with you. Such wonderful analysis. Jen Bartashus, Consumer Staples, Bloomberg Intelligence Senior Industry Analyst. And she covers everything food related, which is just such an
And what
interesting
I learned from
business.
her years ago, which still shocks me to this day, is the number one supermarket chain in the United States is Amazon.
What? No.
I mean, Walmart. I'm sorry, Walmart. Sorry,
Oh, okay,
Walmart.
okay, that
Walmart.
makes more sense.
Yeah, sorry, Walmart.
Right,
And
right.
I forgot about that. But when you do go in there, they're just massive square footage.
It's huge.
Yeah.
I mean, isn't that where they make the majority of their money? Or
I think
volume,
I
guess
think it
I should
drives.
say?
I think it drives traffic, and they
Yeah.
make it on it because I think supermarkets. I think the margins are really, 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 really low. So you make it up on volume, and you bring them into the store, and they buy other stuff.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Okay, let's get to the markets here. The S&P's up 0.4%. You know, I kind of felt like this was going to happen yesterday when we had that big sell-off, particularly as we closed off the lows. But the question is, how sustainable is this sort of buy the dip narrative? So let's ask Nancy Davis, founder and CEO of Quadratic Capital Management. She joins us now from Greenwich, Connecticut. Nancy, how do I understand the price action right now on the main index?
Well, Alex, I think you said it well. It's a little confusing. I mean, it's basically good data yesterday. We had a stronger inflation, less Fed hike or Fed cuts, and that's what's kind of fueling the market. The market's on hope right now that the Fed is going to ease rates and save everything from being overly tight.
So, I'm looking at the bond market here because, boy, in 2022, the bond market just got crushed. There's no place left to hide. The 60-40 portfolio did nothing for you. A little bit of positive performance in last year, thanks goodness to November and December. But here we are starting off the year again in the red for fixed income. What do we do on the fixed income space, Nancy?
Well, it's tricky because the U.S. yield curve is so incredibly inverted. So what that means is that longer dated interest rates are anticipating the Fed will aggressively cut rates, and everybody in the bond market is kind of holding out their hands saying, okay, cut now. And the market being inverted, you're getting paid less yield to take more duration risk. And so the market has been rushing into credit, private credit, public credit. So credit spreads are incredibly tight, right along with their, corporate cousin equities. So those financial assets that are at all-time highs. And then if you look at the, treasury market, you can buy a 1-month T-bill and get paid 5.4%, or you can lend money to the U.S. Treasury for 10 years and get over 1% less. So it's a really crazy environment because the yield curve is not normally this inverted for this long. And it's really, I think, a message to bond investors that you're not being paid to take duration risk.
So it's funny you mentioned that because a week ago, the conversation was, okay, my 3-month T-bill was up. What do I do with the money? Do I go into equities now? Do I do something else? And now it's like, woof, nope, gotta stay because that the money market funds are just really too attractive. How do you then navigate an environment where we're going to get 3 cuts maybe for normalization rather than something more dramatic?
I mean, I think most people do have equities in their portfolio, and the equity market is really hanging on to this premise that the Fed is going to cut rates. So I think it's reasonable to have some short-term treasuries, and I don't think you're really getting paid for the risk to take credit risk because it's similar. If you think about owning a corporate bond and owning a corporate stock, it's a similar corporate beta, and corporates are really expensive right now. So I think it makes more sense to just have treasury exposure and not add that credit risk into your bond portfolio because you already have it on the equity side.
I was surprised last year when we did get some decent performance out of fixed income that high yield was the real outperformer. And I would have thought with all the discussion of, everybody talking about a recession right around the corner that you wouldn't want to take that level of risk. What happened in the high yield space? And I assume just by your previous comment that you're not being enticed by the high yield space this year.
Yeah, I think high yield, investment grade, pretty much anything with a credit spread, what you want is credit spreads tighter if you own bonds with credit risk. And credit spreads are near, their 10th percentile of all-time tightness. So, especially I think I caution people, it's not just high yield, it's also short dated. A lot of people have been going into short duration funds. And if you look at your short duration funds that take credit risk, IG credit spreads are around 30 basis points for the 3-year point. It's even tighter when you go closer in. And there you need a company to amend or extend, right? They either have to pay back the loan or they have to term it out. So it's a really, it can only go to zero, right? So there's very little, you're taking a lot of risk and not getting a ton of return. And so going back to those T-bills, yeah, maybe the Fed is going to cut rates, but then you should be okay on your equity side of the portfolio. And if they don't cut rates, you don't have that reinvestment risk. So I don't think T-bills, they're boring and they're not super exciting, but I don't think they're bad. Yeah.
You also mentioned here in your notes the fiscal situation and watching the deficit. I feel like yes, except no one seems to care. So what do you do with that?
Yeah, no, Alex, you're exactly right. Nobody cares. But I think that's also the time when nobody's talking about something. It's important to be mindful of it because usually that risk is not priced. The Treasury Department does have to refinance a tremendous amount of debt. We have a ton of fiscal spending. We have an election year. There's really even no election premium priced into the volatility markets. I mean, talk about pulling my hair out. I want to grab people and be like, what's wrong with you? Do you realize what's around the corner and what we're going to be facing? So I think that's the time that investors, in all markets, you want to buy things that are low and sell things that are high. And there's certain things in the fixed income markets that are really inexpensively priced. And then there's 90% of the market that's really expensive. So you want to kind of avoid the expensive stuff and buy the cheaply priced things, in my opinion.
So what is the Fed going to do this year? I guess obviously the March cut is off the table. I think people are now really debating May and maybe even suggesting June might be the launching point. What do you think?
I think it's really hard to predict what policymakers are going to do. And then it's even harder to predict what markets are going to do in response to that policy, because it's all related to expectations, right? If we rewind before the Fed started hiking rates and the dot plots started to come out higher, I don't think any economist out there would have said, okay, the Fed's going to hike to 5.25 in about a 12-month window. I think nobody was talking about that. And now everybody is talking about rate cuts. It's just a question of how many, how quickly, and when is it going to happen. I think we also have to be mindful of the Silicon Valley swap lines. So the BTSP program is expiring in March. That's put a ton of liquidity out there in the system. That's going to be coming out. So I think there are a lot of things out there that are catalysts to make markets more normal in fixed income. I think having an upward sloping yield curve, that's not some kind of tail event, right? That would just be normal. Like in normal environments, when you lend somebody money longer, whether it's a sovereign or a municipality or a corporate, you typically get paid more interest to lend longer, right? Because it's more risk. Right now, we're not seeing that. So I think there are a lot of ways to kind of play for a more normal market, and it doesn't necessarily have to be dependent on the Fed just cutting rates, because I think the longer the Fed pushes off the rate cuts, the more the economy, especially all the corporates out there that have debt, will have to refinance. So it could potentially be higher for longer, means more cuts faster later because the economy is really slowing. So I think it's tricky then.
All right, Nancy, we appreciate it. Nancy Davis, founder and CEO of Quadratic Capital Management, talking about fixed income. And then also you layer in the election timetable and the idea that the closer you get to the election, then the more you cut, the more it looks political. And that kind of changes the framework too a little bit.
Yeah. So I think if you start, maybe that takes some of the political risk out if you start early. So we'll see how it plays out.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.